In 2010, two men had an idea: share office space, make work flexible. They called it WeWork. By 2019, the company was worth $47 billion. But by 2023, that dream had almost broken. This is the story of how WeWork rise and how it fell. In 2010, Adam Neumann and Miguel McKelvey founded WeWork in New York. The idea was ambitious: lease large office buildings, divide them into smaller shared offices, then rent them to individuals. They offered flexible lease terms, built-in community, and stylish design and amenities as major selling points. The idea was incredible, and the company grew quickly. They opened locations across the United States and then expanded to London, Israel, China, and dozens of other cities. The company caught the attention of SoftBank, the massive Japanese investment fund led by Masayoshi Son. SoftBank saw potential and invested over $10 billion into the idea. WeWork reached a stunning private valuation of about $47 billion and seemed unstoppable. The idea wasn't satisfied with just providing desks and lifestyle branding. The vision was to create not just workspaces, but an entire culture and movement around how people work and connect. But beneath the sleek surfaces, there was a fundamental problem. WeWork leased large spaces on long-term commitments from landlords, locking in years of high rent payments, even as revenue climbed. In 2017, revenue was high, but losses were also staggering. The company brought in roughly $1.8 billion in revenue, but losses were nearly equal or even greater. Adam's leadership style began raising red flags. Some investors accused him of mixing personal business with company business. There were deals where he or his related companies owned buildings that WeWork then leased, creating obvious conflicts of interest. His behavior, lavish spending, and lifestyle, along with some erratic business decisions, eroded trust among investors and the board. Questions about governance and accountability grew louder. In 2019, WeWork decided to go public. They filed their IPO registration, known as Form S-1, which made their financials public for the first time. Investors and analysts pored over those documents. What they saw alarmed them: massive losses, enormous lease obligations stretching years into the future, revenue that looked unstable and uncertain. The valuation collapsed from $47 billion to a fraction of that amount almost overnight. Adam stepped down as CEO. SoftBank stepped in more aggressively to try to salvage the situation. The company scrambled to cut costs and survive. The dream was crumbling. Even after new leadership took over, the company was still spending heavily. Operating costs remained enormous. Revenue simply wasn't enough to cover the costs. The fundamental business model remained vulnerable: uncertain income from members. If member demand dropped, WeWork still had to pay for empty space. The math was brutal. Then came the global COVID-19 pandemic starting in 2020. It hit WeWork like a hammer, and companies around the world shifted to remote work. The demand for shared office space plummeted. Occupancy rates dropped sharply. Many locations were forced to close. But those fixed lease costs? WeWork still had to pay them. The pandemic exposed just how fragile the business model really was. Suddenly, WeWork was drowning in liabilities. The company had massive lease obligations representing billions in future rent payments. Debt to landlords and lenders kept mounting. Cash flow problems became critical. Investors lost confidence. WeWork tried desperately to renegotiate with landlords and close underperforming offices, but the scale of the problem was simply too large to manage. On November 6, 2023, WeWork was filed for Chapter 11 bankruptcy in U.S. bankruptcy court. The once $47 billion company was seeking protection from its creditors. WeWork aimed to restructure its crushing debt, renegotiate or cancel leases, and dramatically reduce its obligations. It was a stunning fall from grace. In May 2024, a U.S. bankruptcy judge approved a restructuring plan that allowed WeWork to cut billions of dollars in debt. The company canceled or renegotiated many of its leases. WeWork still operates some co-working spaces today. The brand still exists. Members and businesses still use WeWork locations in various cities around the world, but the grand promise of a $47 billion revolution is gone. What remains is a leaner, more scrutinized company trying to operate sustainably. The ambition has been replaced by survival. Thanks to the court for intervention, and subscribe.